How's it going? It is I again. Yeah, yo boy, TJ Tarai Jack, and I'm coming straight live from M5 Property Addicts. And I've got my boy again in the house from Biz House. And this is Lebo. Lebo, how's it going, brother?
I'm all good. How are you, TJ?
Awesome stuff. You had a great week so far?
I had a great week. I had a fantastic one, man. It has been crazily busy. We are actually finally making progress with the lockdown now in level 1. Things are looking great and opening up a bit. So things are moving swiftly. I'm happy with the progress. You had a great week?
I had a great week. Just in case for those people that are going to be watching this in the future and you're wondering what is lockdown. Once upon a time, we were in lockdown. From level 5, there was no booze and no cigarettes.
No movement. We were locked in the house the whole time.
Oh Lord, yeah. It's level. It's been a good weekend, man. A good week so far. Just trying to close off the month, and getting some of the projects in, making sure that we start collecting some rent on those new projects. So yeah, tying all the loose ends so that the new tenants is able to pay us the rent at the required account number and not as to the old previous account number. So small things like that can make a big change.
100% true.
Awesome stuff. If you've never been here before, this is the show that we talk about property and tax and property. It all means the same thing to us. And what gives us the right to be talking about this? Well, I am a property investor and I invest in properties in different cities. Over and above that, I do that for rental purposes so that we can create legacy. We are in the month of September where we celebrate heritage. And I've been saying that we need to create a culture. What is heritage? Heritage is just an idea that gets passed on from generation to generation. That's what heritage is all about. And the challenge that I'd like to put on our table, which Lebo and I we have caught on to, our idea is buying properties, develop them, rent them out, and we do that every day. Lebo left his employer, right?
Yes, I left my employer in 2018.
Yeah.
I've been a property investor and a property developer ever since I've left employment.
It's a heritage that you can pass on.
Yes.
There's someone said to me, you know what, TJ, as an employee, you can never pass on the heritage of your employee number or your job title at work.
100%.
I'm not saying it's bad to work. It's good to work. Lebo and I will still work. Lebo works in his company, his house. But here is the difference between us and other people there. Lebo and I, we work for assets. And the assets pays us. Near Lebo.
100%.
Are you exchanging your time for money?
No, I'm actually investing my time into acquiring more assets, and then those assets will work for me to make me money, to pay me money. So I work for those assets, and then those assets work for me to create income, and then as a result, that income pays me. So it's more like it's a short and long term investment at the same time.
Yeah, but if you're earning 100,000 today, in 2 years' time, is it still 100,000?
Not at all, because you remember, 100,000 in today's value, it will be less because of inflation. When you're taking into consideration inflation rate, currently it's sitting at close to 7%. So that means next year, this time, your 100,000 would be 7,000 less in terms of value. In terms of digit, yes, it will still appear as 100,000, but in terms of the buying power, it will be worth 7,000 rand less.
You've got assets, I've got assets. In terms of your assets, the inflation is going up. What's happening to your assets?
So especially our type of asset, our asset types is mostly properties, and properties has been known to appreciate in value over the years, irrespective of the market. So it's one of the asset classes that has been consistent throughout. Yes, it has taken a few knocks here and there, but it was able to recover successfully over the years, and it's still appreciating till this day.
Yeah, awesome stuff. That was just by the way, and you can do the comparison on your own. Versus working for an employer, and no ways are we saying that being an employee is bad. It's not. We all started there. However, you need to find your niche, and if property is one of those things that you need to be doing, get educated, start buying something, start from somewhere, and this is what we represent. Good. Lebo, what are we talking about today?
We are talking about property and taxes. We are talking about the benefits of property investment in comparison to when you're buying in your name or in your company or in a trust. So we just want to compare the three to say which one is the better option for you. But you need to decide for yourself depending on your goals, where you are, what you want to achieve with that investment, and also, to compare which one will be best suitable for you and the goal that you are looking for to achieve.
Awesome stuff. I like that label, because I think in the past couple of videos, and ladies and gentlemen, if you haven't caught up any of our previous videos, you can literally go back and check out some of those videos, because we've been talking about benefits and benefits, because a lot of us think that tax is bad and SARS is bad. But actually, me and Lebo, we actually think the government is out there to be our business partners, and they've been generous to us. And we all want to continue singing this song so that you know that there is tax benefits. And if you don't know some of those tax benefits, refer to some of the previous videos that we have done, or speak to your tax practitioner so that they can indicate to you some of those benefits. So we are not going to dive in a lot into that today, but we want to talk about the different structures that they are there in comparison to the other. So we're not saying that versus the other one is bad or good. We're talking about in comparison, because your situation plays a very pivotal role in you deciding what you want to do. For instance, my business structure is that I have a trust, and under the trust, we have shareholding, and the shareholding sits in the trust, and I do everything in a business, in the company, because everything sits in the company. I have business partners. Transparency is big in our team. So all of our businesses, we do them in different companies, but in a company. Why do we do that? Also so that we can expense a whole lot of things in there, and we can also have the tax benefits or thereafter. However, if I get a simple deal where I can literally just buy it and flip it for 100,000 and I get 50,000 out of it, I might just do it in my personal space, right? Because I don't have like big salary incomes coming through to me. I am just Joseph, right? Now, Lebo, from that perspective, I have utilized everything that we are talking about: the trust, the company, and myself. And I hear a lot of people always asking me, so which one works? Which one should I be using? And again, I think it's about you. Lebo, over to you. what is your preferred structure and why?
I'm actually currently using all the three. I have properties that I buy under my personal capacity. I mean, if my banker calls me and say, "Look, we can give you another property. You know, how much? Do you have any other deals that are on the table that you can take under your personal capacity?" I'll definitely jump into the opportunity without even thinking twice. And you know, and I also do it under a business. So we have you know, a couple of properties that we are doing under the company, mostly developments. And I also, because I am thinking, you know, estate you know, estate planning.
Yep.
So I'm thinking generational wealth. So hence I also have a trust that has been set up for other tax benefits. I mean, if you are looking for a continuous benefit, you can set up that. Then you have your beneficiaries or your trustees that can receive. You can move, although the trust is taxed at 41%, but you still have a benefit of moving the proceeds from the trust into the trustees or the beneficiaries, and then they're going to be taxed at their personal marginal rate.
Right. So
Yeah.
you use everything, and you can see here, ladies and gentlemen, there is no right or wrong answer, right? All these structures are there for us to utilize. You just need to make sure that, you know, you are aware. And this show here is to create that awareness so that you know exactly what it is. So let's talk about label. A very small deal for 1 million rand. We are buying a deal for 1 million rand. And in this case here, there is me as the individual, and there is the company, and there is trust, right? How would you determine, so this is the comparison part of it, how would you determine at that particular time which structure to go with?
All right. That would depend if when you're buying that piece of property, that would depend as an individual. What is your goal? What do you intend to do with that property? First thing first. If you're intending to rent it out and to keep it for the long run, you look at your current income as under the personal capacity to say, look, personally, I am taxed at the highest tax bracket. Then if you are taxed at the highest tax bracket, it would not be ideal for you to take it under your personal capacity, because your rental income is also going to be taxed at your personal marginal rate, which is up to 45%. So you look at that as an individual. Secondly, you also look at your exposure. So if you run into troubles, so you have exposed your assets to creditors, it can easily be attached, you know, as if you default on your credit. And also as a business person, I mean, as a business person, you are also exposed to a lot of risks as an individual. So you're also exposing your assets. So there's a certain level of risk in terms of your asset that you've exposed to. And another thing is, when you under the personal capacity, you're looking at when you pass on. Now your property is going to be locked into your estate. So that would also attract.
And by the way, I think label, I want to speak to that point, right?
Yes.
Taxes are there, right?
100%. Yes.
They're there, and they are coming for us at some point. We need to decide which side of the fence. When they come for us, are we in the right side or the bad side? The second thing is death, right? Me and Lebo, one day we're going to die. It might be sooner, it might be later, and we're going to meet Jesus, right? But the point here is, we can't run away from death.
No,
right?
we can't. Yeah.
And if death is coming, how come we don't stop and think to prepare for it, right? Because a lot of us, we are in burial societies. A lot of us, we have funeral plans. A lot of us, we have all these things that are meant to entice or look after for a short period to our loved ones, you know, but soon after that, you know, life fizzled out. Someone who was very wealthy, the wife can't keep up with expenses and things like that. They move out from the big house, they go and stay somewhere. I mean, these are things that are happening in our societies. And labor, for me, you are touching on a very important topic there.
Yes.
Right? And we never look at that. It's like this ghost that we can't talk about.
But it's meant for us, all of us, actually.
Yeah, it's meant for us, black or white.
Yeah,
Indian, colored, whatever, you know, but so yeah, sorry man, I just felt the edge of coming in there to talk about what happens. We all going to die at some point, and estate planning is important, and you are diving in to say it is important, and utilizing a trust for you, that's your mechanism of managing that.
Yes, 100%. So like I was still saying, to say when you pass on, then your property will now attract executive fees at 3.5% plus VAT, of which is just under 4%. And then you also have an estate duty at 20% of assets that are above, I think it's above 3.5 million. So under the personal capacity, those are the taxes that you are most likely going to attract. And then when we move on to PTY, to a company.
Before you go on to the PTY, so you are saying, Lebo, you have worked your entire life.
Yes.
And now you are dead, right?
Yes.
20% plus 3% and odd 3%. So we're now 23%. Yes. And another 6-7%. So we're now on 30%.
Yes.
Before that, you were an employee, you were given the government anyways, another 50%.
Yes.
Right. So now you are dead. You throw in another 30% on top of the 50% that you were giving them. I'm just like, it's not making sense for me why we continue doing this, man. Like, I don't understand it.
Yeah. I think that's where you need to sit down with your, with your advisor in terms of when you're doing, or your legal advisor, in terms of when you're doing your estate planning. I think all of us, irrespective of how much asset you have, I think you need to do an estate planning, or sit down with an estate planner at least once a year.
Right.
At least, meaning minimum, if you don't want to do it often, or if you don't have any much changes in terms of your assets, then at least once a year, sit down with your estate planner, to review your plan that you did last year, to see where you are now, what have you added, what has changed, and you look at what are the benefits, the pros and cons in terms of your estate planning. So I think it's very important for all of us, irrespective of your level of assets, to sit down with an estate planner to do an estate planning, and also to check how much tax are you going to attract when you are no more.
You heard it right. Uncle Lebo said once a year, go and check it out, right? At least once a year. But this is not one of those scenario, Lebo, where we say what you focus on is going to happen. Eh?
No.
This needs to be done.
No. Remember, whether you focus on it or you don't, at some point, we all have an appointment with death.
Come on.
So at some point, it is going to happen. I mean, we don't know when, but it's better to be prepared for such an event when it happens than not. Because if you're not prepared for it, you might leave your loved ones when you're thinking that you've prepared well for them, but little did you know that your assets are going to attract this huge um, tax when they are winding out your estate, and as a result, your dependents or your beneficiaries are going to be left with less than what you thought you have left them with. So for the benefit of your generational wealth or the assets that you want to leave for your loved ones, I think it's very important to also plan to that point, to up to that point to say, look, I need to plan also the same way as when you take your funeral plan and your life covers and your disability and all these insurance that you take for to protect your assets, to protect your income and stuff like that. It's not when you're taking a car insurance, you're not saying you're going to have an accident tomorrow. It's not that you are focusing on having an accident tomorrow, but you're saying, should it happen that you get hijacked, should it happen that your car is damaged, should it happen that you are involved in an accident, then you know that you have a cover for it. So in this case, it's not should it happen, it's when it happens.
100%.
So so it's even worse. It's even worse if you are comfortable taking out a car insurance, but you're not comfortable planning for your death. I
Sure.
mean, your death is inevitable, but your car accident or car damage or car theft or hijack, it's a probability. It might not happen. You might pay for 15, 20 years for that insurance, but it might not even happen for you to claim from that insurance. But in this case, in terms of you dying, it's inevitable. It is going to happen. So you should think of it in a sense of it's an event that is going to occur, whether I like it or not.
Sure.
So it's better for me to be prepared for it because it's inevitable.
100%. Uncle Lebo says go and see your tax guy and your planners, what, at least once a year, right?
Yes.
And
Yes.
me, Uncle TJ, I am saying just do it. Whether you're dying or not, you need to do it, right? But
Yeah.
make sure that you are running away from leaving more money to people that don't love you, that don't know you. They just know you as a number, but leave money for more people, leave more money to the people that you love, where you want it to be. And yeah, I think we're going to end it there. Jump on, buddy, to the component now where we're talking of the same deal, but now we're doing it in a company.
In a company, yes. So when you're looking at it in a company now, so in a company, then you are only taxed up to 28%
Right.
in terms of your net profits, right? So your net profit, you are taxed at up to 28%. And then in order for you to move the money out of the company into your pocket, then you are trapped an additional 18% of your what is called a dividend tax.
Right.
So dividend tax is fixed at 18%. In order for you to take your profits into your pocket, so you attract an additional 18%. And then, should you now want to sell the properties, then you attract what is called a capital gains tax. That is in a company.
Yeah, but let's be realistic right here, right?
Yeah.
I'm a business person. My only income would then come from the company itself, right?
Yes.
especially like you and me. So I can also dictate a salary to myself other than dividends.
Yes. 100%.
Right.
100%.
So I've got an 18% there. I give myself some small dividends. So it's at an 18%, up to 18%.
Yes.
And if the company is doing very well, again, I can distribute small amount, big amount. It carries the same amount, 18%.
Yes. It does not change. The percentage is fixed at 18%. So irrespective of you give, for instance, let's say you give yourself a minimum of, a minimal amount in order for you to survive for the rest of the year, to be
Yeah.
able to comfortably live your life for the rest of, for 12 months. So irrespective of how much your company makes in a year, or if every single month, you just give yourself 30,000 rent salary, you just pay 6,000 rent to SARS and throughout the year. And then at the end of the year, when you now are issuing dividends, irrespective of how much dividend you're paying to yourself, the 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 dividend tax rate, it still remains at 18%, irrespective of the amount that you're paying to yourself. But if you now, because now your company has made 5 million this month, you want to increase your salary to 100,000, I have bad news for you. Then you are going to carry a lot more tax, because you are now take your income tax bracket, it goes high.
Right.
So as opposed to, fixing your salary for the rest of the year, and then just work with your salary. And at the end of the year, then after net profits, you can now declare your dividends, and you just take it at 18%. You pay it at fixed rate of 18%, of which it's actually, in terms of personal income tax, that is the minimum tax rate that is taxed to individual salary earners.
Wow.
It's 18% of one rent. That is, it's so our tax brackets are from 18% of one rent up to 45% in terms of personal income tax. So individual personal income tax, it's from 18 to 45%. But in terms of when you now earning dividend is fixed at 18%, and then that's it.
I think there's lots of things that we don't know. I'm glad that we're having these conversations. In my view, the comparison here, my heart aches for what I see out there.
Yeah, yeah.
That's number one. Number two, I think that we are leaving a lot of money on the table. What is that word again that you like to talk about? Evade and
Oh, avoid. So
right?
we need to learn how to avoid tax, but not to evade tax. So tax evasion is illegal, but tax avoidance is legal. So there are allowable tax allowances and things that you, or ways how you can plan your taxes in order for you to avoid paying a lot more tax, or pay any tax at all. So there are ways that you can do that within the law that allows you to do it without evading tax, because evading tax is illegal.
Now, I don't know what I don't know, Lebo.
Yes.
Who can help me with all of this?
Uh,
So now
I think
my eyes and ears have been opened. I'm like, yo, this TJ guy and Lebo, where can I go?
so. Your first point of reference, I mean, in terms of structure, you can just approach your legal guy, your attorneys. They are also able to advise you in terms of structuring your deals, or any property structure that you want to go into, investment structure that you want to go into.
Yeah.
But I think your best bet would be your tax practitioner, because they understand the tax implications that comes with every single structure that you might choose, and they are able to advise you accordingly. from other than the tax practitioner, you can go to your tax accountant or your accountant or your chartered accountant or your business accountant. Those are the people that are able to advise you and guide you accordingly without misleading you, because they have the relevant knowledge and expertise in terms of dealing with tax and SARS.
Okay, no problem. I think let's jump into it now. In terms of rounding up, my takeaway here today, Lebo, is that all of
these. Before you round out, I think you've left the last one, which is your trust.
Yep.
Yeah. So in terms of if you are now investing, in terms of if you're setting up a trust has is one of it attracts one of the highest tax brackets, of which is 41%. But having said that, the good thing is you can move the rental income from the trust to the trustees or the beneficiaries, and then they can, if they have the lower tax bracket, they can be taxed at their marginal tax rates. So I think that's the easiest way of doing it.
So they are taxed on the basis of their income.
Yes.
So if they are on zero income and all of a sudden they are on 20,000 a month, that's in today's percentages, then that means that they are being taxed at around about 18%, like an entry tax bracket.
Yeah.
But
that is before tax rebates.
Right.
So this 18% is before tax rebates. So they might end up not paying tax at all.
100%. And if they are already in a higher tax bracket, then that applies.
100%.
Okay.
So hence I said, when I started, I said, depending where you are and what's your goal.
Right.
And so those structures will apply accordingly. So in comparison of the two, so the first one, which is it's easy and it's by default, people will buy into their individual capacity. It attracts the higher you go in terms of income and income tax bracket, the higher tax you attract. And there's no continuity, because when you die, I mean, it falls under the estate and it attracts a lot of taxes in terms of that. So it's not really ideal to do it under your personal capacity. And below that, then you have a company, of which it attracts your up to 28%, and plus your dividends tax. Then that also is good, because there's continuity in there. Unless if you liquidate the company even post your existence, it still continues to live. And then when it comes to a trust, now a trust has trustees. A trust doesn't die, so there's continuity in terms of that. So I think when you're comparing the three, so the first one, which is individual capacity, there's no continuity in that. When you die, that whole estate dies with you, so it needs to be unwinded. And then the PTY doesn't die unless if you liquidated. And also the trust doesn't also die. So it's the trust, I think, is ideal when you're doing an estate planning.
The other thing that we haven't really touched on, Lebo, here, is that when you and this came into my mind now when you're talking about not dying. So you've got, when you're buying using debt, the moment that you are late, right, you pass on, and you've got debt, the bank is going to call on what's due.
Yeah. Yes.
Right.
Unless if there was insurance that will cover that. If
right.
there isn't, then they attach that to recoup their debt.
We could lose everything. There's a risk in that. If it isn't a company, not necessarily so, because the company can leave even though the owner of the company is late.
100%.
And that's the same thing with the trust as well.
100%.
I think let's end it there for today.
Yeah, let's keep it there.
It's a
Yeah,
bit
but
hard.
just one more thing
Yeah.
in terms of debt. So it's not only the debt on the asset that the bank is going to come up after. So any other debt, even if the asset, the property is debt free, but because you have other debts that falls into your estate. So when they are unwinding your estate, so they need to pay these debts, offload these debts before they can, transfer the properties or the assets or the monies that are left out to your beneficiaries.
Lebo, I think let's speak about life after death. Next. Because I think a lot of us, we're not aware of this. And I'm speaking for myself here, man.
Yeah.
So we don't know that. What happens, when you're gone, So you've been buying all of these properties, you think that your kids and family are secured, but you're gone. So what happens? What is the reality? And all of these things are documented. And I think we're going to cover that up in the next couple of videos so that we can give different scenarios. The idea here, ladies and gentlemen, is to make sure that you are making informed decisions to grow your asset and to grow your generational wealth. That's what we are here all about. But in relation to tax, so that it can benefit you. Lebo, you want to close off?
Yeah, in my closing comments, I think the best thing that you can ever do for yourself is always to consult the relevant parties. In this case, with today's episode, I think the most important aspect that you need to consult about is your estate planning.
Right.
So consult your estate planner or your attorney to do your estate planning for you. If you don't have an attorney, I think financial advisors can also help you with that. Or alternatively, just consult a tax practitioner or tax consultant. They'll be able to assist with you. They'll be able to assist you and help you and guide you in terms of planning for your after death.
Boom! You heard it right. And that was Lebo and TJ signing off. God bless and goodbye.
Cheers.